Hello and welcome to day 4 of Pension Awareness Week. I'm John Sherlock from ICSP and I'll be your host for today's webinar. Joining me today we have Catherine Murray, Training and Engagement Manager from ICSP, Emily Wilson, Senior Training Consultant from ICSP, and Tim Ferber, Client Director of Legal and General. From Cabinet Office today we have Andy Jones, Engagement Manager for Civil Service and Royal Mail Pensions. Today's session is all about how to boost your benefits. And even if your retirement isn't far away, there are ways to increase your income right now. Today, our experts are going to walk you through various ways you can boost your pension and provide an overview of what a comfortable retirement might look like and how to work out if you're on the right track for the retirement you want. There will also be a demonstration of the added pension calculator, which is a really useful tool available on our website. Okay, so you may notice that we've changed the format of today's session. So instead of posting individual questions to the panel, you'll be asked to vote on a range of topics that you'd like our panel to discuss, and we will be putting the most frequently asked questions on those topics to our panel later on. We've done this based on feedback from attendees of previous sessions, and it means that our panel will be able to answer the most frequently asked questions on the most popular topics. Okay, so without further ado, we're now going to jump straight into today's session. And to begin with, we'd like you to tell us which topics you'd like our panel of experts to discuss later on today. To do that, simply choose 2 topics from the voting options that should have appeared on your screen at the start of the session. You'll be able to do that for the next few minutes, so please do vote. Whilst you're doing that, I'd just like to remind you to give us your feedback on today's session. You can do that by completing a short survey that will be emailed to you later on. Your feedback really is important to us as it helps us to improve and tailor these events to you, so please do take the time to complete it. Finally, if you do have a specific question or a problem with your pension that isn't covered in today's session, I would urge you to consider taking part in one of our Pension Power training sessions. Pension Power is a 1-hour webinar delivered by pensions experts. It's completely free and it's designed to help you get to grips with your pension. If you'd like to know more about Pension Power, please stick around until the end of today's session when I'll be telling you a little bit more about it. Okay, so before I hand over to Catherine Murray, we're going to launch our second poll of the day. And the question we would like you to answer is, how do you currently manage your pension? That survey is going to be live for the next few minutes, so please do let us know your answer to that one. Okay, so I'm now going to hand over to our first speaker, Catherine. Catherine will be showing us some ways that you can boost your pension. So over to you, Catherine.
Thank you, John, and afternoon, everyone. Thanks for joining us today. I'm just going to get my screen shared up and ready, and then I'm going to run through this. So joining today's session, presumably you're already thinking about retirement and thinking about the future, which is a great thing, whether that's a couple of years away or whether it's quite far into the future. But obviously you're giving some thought to what your pension's going to look like in retirement and what you're going to have in terms of finances to lead the kind of lifestyle that you want to in retirement. So there's things that you can think about. So the first thing that you really need to know before you start thinking about whether you're going to boost your pension or not is what your pension's going to look like already when it comes to retirement. So if you haven't used the Civil Service Pensions Retirement Modeler as of yet, then that certainly would be a first thing to consider. So that will project what your future pension benefits are likely to look like when it comes to retirement. So if you're not yet on the pension portal, using that modeler in conjunction with your annual benefit statement, then certainly that's something that you should consider doing as soon as possible. And then you can start putting the pieces together. So you've got an informed picture of what your retirement's going to look like. So a visit to the retirement modeler is a really good shout first and foremost. So the things I'm going to talk about here, we're going to look at the different options that are available to you. So things such as added pension. And like John mentioned, I'm going to do a demo of the added pension calculator for you when I finish this presentation as well. The option of EPA, or effective pension age, and civil service AVCs, or additional voluntary contributions. So those are the 3 main ways you can choose to boost your pension in the civil service pension scheme. So we'll talk about each of those and how they work. Important to mention the tax relief that you receive from the contributions that you pay towards your pension and how that sort of builds into what the costs would look like. And linked to that, HMRC's annual allowance. There is a limit to how much you can save towards your pension before you get a potential additional tax charge. So that's something to be mindful of, particularly if you're quite a high earner. We're then going to look at transferring in. So there are some potential options to transfer in, though you do have to do that at the very beginning of joining the scheme. So it might be that that deadline that you have has now passed, but we'll just explore that option. If you're thinking of opting out, so just some key things to know, is that a sensible choice? What else do you need to consider when you're thinking about doing that? Particularly our partnership scheme, which if you're considering opting out because of the cost of paying in towards your pension, you might want to consider partnership as an alternative, which can cost you less. We'll talk about finding lost pensions. So if you've built up pension benefits elsewhere that you've lost track of, then you can find out some information about them. So we'll share some key facts around that, and also a look at the state pension as well. So what are you going to get from the state pension in addition to your civil service pension when retirement does come? So first, we're looking at added pension. And added pension is exactly what it sounds like. You're going to buy yourself an additional amount of pension, which will be then payable to you every year in retirement. And the only option that's available to members now is to buy added pension in alpha, as you can only buy added pension in the scheme you're currently contributing to. So if you're looking to buy added pension now, you'll be buying added pension in alpha. So what that means is then you'll be paying additional contributions, and that builds up an additional annual amount of pension that will be payable to you every year in retirement. And there are two different ways you can pay for added pension. You can make additional monthly contributions from your salary, or you can make a lump sum payment once per tax year to buy added pension as well if you prefer. So if you're interested in this option, the first thing you would need to do is to visit the added pension calculator and then complete that to see if that looks like it's going to be a viable option for you in terms of what you think of the cost. Like I say, we'll do a demo of that later on so you can see what that looks like in real terms. With added pension, if you want to make those monthly contributions from your salary, then your contributions have to start from the 1st of April, which is the first day of our pension scheme year. So each year we have a deadline for applications for added pension purchases, both by monthly contributions from your salary and a lump sum deadline if you would like it to count in the current tax year. And those tend to be in sort of end of February for lump sums, early March for monthly contributions from your salary. And your employer will publish that deadline for you somewhere every year, generally on your intranet. So it is quite time sensitive. So you do need to consider that and bear it in mind if you're considering this as an option. As if you miss that deadline, particularly for the monthly contributions, then you've got to wait another 12 months before you're able to do that. So the added pension that you buy, the calculator tells you what you're going to get back, and that amount is essentially guaranteed. It's not going to shrink in value. It's going to be increased annually in line with inflation. So it's going to keep its value over time. So it's quite a safe way to choose to boost your pension. It's not based on any kind of investment. So you do know what you're going to get back for the contribution that you make. So buying added pension is option one. And I'll tell you more about this shortly when we do our added pension calculator demonstration. Your second option is EPA, or effective pension age. And this is an option within Alpha to pay an additional monthly contribution, not to build up additional Alpha pension benefits, but to pay more to have your Alpha pension benefits payable to you from an earlier age. So the benefits that you build up in Alpha are payable to you from your state pension age without reduction. If you know already that you want to retire before your state pension age, then you might like to consider this EPA option, and you can pay extra, and that then makes the Alpha pension benefits you're building up payable to you from an earlier pension age. The earliest pension age you can buy using this method is age 65. So you can't bring your Alpha pension age down below the age of 65. So say, for example, your state pension age is 67. You could pay extra for a -1 EPA, which would make your pension payable instead at age 66, or -2 would make your pension payable at age 65. The -3 option only available to those members who have a state pension age of 68. So there is a calculator on the website for this option as well. Complete that based on your personal circumstances, and that will tell you how much extra you'd have to contribute as a percentage of your earnings to reduce that pension age down using this method. Lots of people that I speak to, they hear about EPA and they think it sounds like a good option, but then they say, well, it's no good for me because I know I want to retire earlier than age 65. Still might be an option you'd like to consider. So say you're in that scenario, your state pension age is 67, you're going to buy a -2 EPA, which then makes your pension payable from age 65, and then you decide to retire early at age 60. It means rather than having your pension being reduced for being paid to you 7 years early, it's only being reduced for being paid to you 5 years early, because it's like you've already paid for those other 2 years of reduction in advance through that extra contribution from your salary. So still might be an option you'd like to consider if you know that you'd definitely like to retire before your state pension age. You can only make payment for EPA through monthly contributions from your salary. And like added pension, those contributions have to start on the 1st of April. So the deadline for applications again for this would be early in March, and your employer will publish that somewhere online in the new year. So look out for that if you think this is an option you'd like to consider. So you're paying extra with EPA, not to get extra pension, but to make the pension that you're already accruing payable to you from an earlier age. The third option you have to boost your pension is the Civil Service AVC scheme, or additional voluntary contributions. And with this option, you're building up further pension benefits, but this time on a defined contribution basis. So you'll pay additional contributions through your salary, which will be invested by Legal & General, who look after the AVC scheme. So the money that's paid in will be invested, and it's the performance of the investments that influence what's available as a sum of money to buy your additional pension benefits at retirement. And with this option, you've got a lot more flexibility over how you claim your additional pension benefits. So you can build up an AVC fund that you can take in a multitude of different ways when retirement does come. So for example, you could build up a fund and take 100% of it all as one lump sum at point of retirement, although only 25% of that would be tax-free. The remainder would be taxable. You can buy an annuity, so have a regular monthly pension paid to you every year for the rest of your life. Or you could go for some of the maybe flexible drawdown options where you're taking regular lump sums at different times from the pension benefits that you've built up. So you've got a lot more flexibility over how you claim your pension benefits from your AVC, but you have got the risk associated with it here. So it's all based on investments and how those investments perform. So that can be unpredictable and something to bear in mind. Depends how risk averse you are as to whether this option might be attractive for you, whether you might want to consider something like added pension, which has more of a guarantee to what it is you're actually going to get back. Your AVCs you can claim at any time from age 55 onwards. You don't have to claim your AVC fund at the same time as the rest of your civil service pension benefits. You could claim it whilst you're still working if you want to, although you'd need to be mindful of any tax implications that might have. Or you could claim it at a later time if that's what suited you better. So you've got a lot more flexibility with AVCs, both how much you invest and also when you claim those pension benefits. AVCs can only be paid for by monthly contributions from your salary, and you can start and stop those contributions at any time, and you can pay any amount from £10 per month. There's lots more information about AVCs available on the Civil Service Pension Scheme website, and that includes links to the Legal & General website to find out more about where your money will be invested. There's a default investment fund that you can choose, or you can, make some choices in terms of where your money is going to be invested with different strategies that are available. So more information, including the application form, all available via the Civil Service Pension Scheme website. So those are the three main ways that you can choose to pay something extra towards your civil service pension. It's important to note that the contributions that you make towards your pension do attract tax relief. So you do feel the benefit of tax relief on any contributions you pay towards your pension. So we've just put together a little example there to explain that. So we've got a member who earns a salary of £60,000 and they pay 7.35% as pension contributions. So their salary post-pension contributions is £55,590. So that means that £5,320 of her salary falls into the 40% tax bracket. Instead, if she wanted to, this member could choose to put that £5,320 into her pension scheme instead and benefit from tax relief. So there are additional benefits, as well as building up pension benefits for the future. You can actually pay less tax, save some money by investing that in your pension. So that applies whichever pension contributions you're paying with all of these options. Each of the options, added pension, EPA and AVCs, all attract tax relief. So that's something to factor in when you look initially at the cost. It's not obviously necessarily going to cost that whole amount, as you will be benefiting from tax relief as well. Something that's important to note though, HMRC's annual allowance. So this is the limit of how much your pension savings can go up in one tax year. And it's detailed there on the slide as the pension input period, which is essentially just the same as the tax year. That's the period of time over which the growth of your pension is assessed. So the limit to how much your pension can grow in one tax year is £40,000. Any savings above the £40,000 limit, you don't get tax relief on those. So it is something to be mindful of. So how that's worked out can be quite complex when it comes to a defined contribution scheme like AVCs. The £40,000 is just based on how much you've paid in as a contribution. But when it comes to defined benefit schemes like our civil service pension schemes and the added pension option, then it's a little more complex. It's assessed against the growth in your pension each year. And it's the growth in your pension each year multiplied by a factor of 16. That's how we test your benefits against the annual allowance. So just to put that into context, if you say, for example, at the start of the tax year, your pension benefits were £10,000 per year, and at the end of the tax year, your benefits were £11,000 per year. Your pension benefits have grown by £1,000 in that 1 year. That £1,000 is multiplied by 16. Therefore, 16,000 is the figure that's tested against the annual allowance. So that's just a rough example of how that works. If it's something you're concerned about, there's lots of information on HMRC's website in terms of how the annual allowance works. And something that's useful to know, if you do breach the annual allowance in your civil service pension scheme, then we will send you a pension saving statement, which lets you know that. So you will be informed. It's not something you'd necessarily need to work out for yourself, but you would need to think about if you're contributing to multiple different pension schemes at the same time and looking at all of the figures together. So it's not an issue for too many people, annual allowance, but is something just to consider before you make any commitments to make any additional payments towards your pension. Transferring in. So transferring in can be an option. However, you have to transfer any pension benefits into your civil service pension within your first 12 months of joining the scheme. So if you have been in the scheme for longer than 12 months, then that's no longer going to be an option that's available for you. But if you are within your first 12 months of service, then it is something that you can do. Apply to the scheme, and they will get in touch with your previous pension scheme and find out whether a transfer in is possible or not. If it is, they'll give you a quotation of what that would buy you as additional pension benefits. So what additional annual alpha pension would you get if you transferred that pension in? So those time limits are there. And as part of the process, we'll give you a quotation. It's only once you've seen the figures that you need to decide if you definitely want to go ahead or not. So there's guidance on the scheme website if you do need to follow that process, but you can only do it within your first 12 months of service. So some members could be thinking about opting out of the scheme at the moment. They wonder what's the benefit to it. And particularly at times like now, where cost of living is really hitting quite a lot of people, the cost of lots of things are going up. People might think, well, I'll save some money, I'll opt out of my pension. But it's important that you consider all of the things you're giving up if that's something that you're thinking about. So the Alpha scheme gives you an annual pension that's payable every year for the rest of your life in retirement. And if you didn't have those pension benefits, then how could you afford to live at point of retirement? So you need to think about what's going to cover your salary when you're no longer working any longer. As mentioned, you get tax relief on the contributions that you pay. So it might look on your pay slip, for example, that £75 is coming out of your salary every month. But actually, if you opted out of the scheme, you wouldn't get that full £75 back, because some of that's going to be the tax relief that's being applied. So it wouldn't necessarily give you that full value back. And you're also giving up some other really valuable benefits by not being in the scheme any longer. So for example, we've got the lump sum that's payable on death in service. That wouldn't be payable if you opted out of the scheme. Benefits such as ill health retirement, you wouldn't be covered for ill health retirement benefits if you've opted out of the scheme, and also dependent pensions as well. So on the death of a member, pension can be payable to a surviving spouse, partner or civil partner, as well as pensions being payable to dependent children as well. You're not going to have those benefits payable, certainly not at the same rates if you've opted out of the scheme. So you need to make sure that you consider all of the factors that are involved before you make a decision like that. And the really good news is that a very small number of members of the civil service have chosen to opt out. Less than 1% of all civil servants have actually opted out of the scheme. So it's not a popular choice, which is really good to see, because there are so many benefits to the scheme and you wouldn't necessarily get these benefits with another employer. So it's really good to be able to make the most of them when they're available to you. But if you are still thinking, well, I could do with that extra money back every month, I can't really afford to pay this for 5.45% or whatever it is that you're paying every month as contribution towards your pension, maybe you could consider our partnership scheme. Or you might just want to consider this anyway if you prefer this type of pension scheme. So anyone can choose to opt out of Alpha at any time and switch across to partnership instead if they would like to. So partnership is our defined contribution scheme. So similar to AVCs that we talked about before, it's based on investment in the stock market. So what you're going to get back at retirement is harder to predict. We haven't got predetermined formulas like we have with Alpha to predict what you're going to get back at retirement. But you can choose this option. And one of the most attractive things with it is you get to choose how much you're going to contribute towards your pension. So with Alpha, there's a fixed rate of contribution you have to pay to be a member, somewhere between 4.6 and 8.05% of your earnings, depending on your salary. But with partnership, you choose how much you'd like to contribute. And that can be anywhere from absolutely nothing all the way up to 100% of your salary. It's entirely up to you how much you decide to pay in. Employer contributions to partnership, somewhere between 8 and 14.75% of your earnings, depending on your age. And if you do decide to contribute to partnership, then your employer will match your contributions up to a further 3% of your salary as well. There's still a really generous employer contribution going into partnership if you opt for this scheme. So if you opt for partnership, the contributions that are paid in are invested. And again, you'll have a choice of investment strategy. You can make some choices, or you can go for the default position, whichever works for you. And Legal or General will let you know how your fund's building up and what that could then look like in terms of pension benefits at retirement and the different options that would be available to you. You can choose to switch across to partnership at any time. You just need to give your employer 2 months' notice of your intention to switch schemes. And if you opt for partnership and then further down the line you change your mind, you're always able at that point to switch back and rejoin Alpha. So it doesn't have to be a permanent thing. You might like to try it out for a year or two and see how the investments perform. And if you wanted to at that point, you would be able to switch back and you could rejoin your previous Alpha scheme as well. Something else to consider. So if you've ever built up pension benefits elsewhere, do you know where they are? Do you know how much they are? And do you know when they're payable to you? So it may be a case of when you were younger, you weren't sort of that focused on your pension. A lot of people generally aren't. And maybe you think, well, I think I paid into something when I worked for X employer, but I can't really remember. So it's well worth taking some time to track those down. You might have some correspondence with contact details, so you can get in touch with those schemes. Make sure they've got your up-to-date contact details and you can find out what the current value of those benefits is. If you haven't got anything like that, then you can use the pension tracing service. This is a government-backed scheme, and they hold the contact details for all UK registered pension schemes. So if you say used to work for a company that doesn't exist anymore, so say for example you worked for Woolworths and they don't exist, then you can look on the pension tracing service and they will know who looks after their pension scheme. And so you'll have the contact details, so you can get in touch and make some inquiries. Even if you're not sure, you think, I'm not sure whether I contributed or not, it's definitely worth an ask. You never know, there might be a pension there that you didn't even realize you had, and all that's going to feed in and you'll get the benefit of it when retirement comes. And then your state pension needs to be considered as well. So currently the full rate of state pension is £185.15 per week. And to be qualified for that full state pension, you have to have at least 35 years of national insurance contributions. Your state pension is adjusted every year in line with inflation. So it was just announced in the autumn budget last week that 10.1% inflation will be applied to state pensions in April 2023. So that weekly rate is going to go up to about £203, £204 a week when it comes to April next year. And that continues obviously to grow in line with inflation every year. Now, between 1978 and 2016, the Civil Service Pension Scheme was a contracted out pension scheme. So members of the scheme in that time frame paid a lower rate of national insurance. And what that meant was in that time, they didn't build up any entitlement to the additional state pension or the second state pension. SERPs, it's been given various different names over the years. It's not that members didn't receive that additional pension. It's just that it was paid as part of their civil service pension rather than being paid by the state. The government abolished contracting out in 2016. And at that time, we all started paying the full rate of national insurance contribution. And then therefore you are able to build up the full level of state pension, so the £185.15 per week. If you haven't been on the state pension website and got a state pension forecast, it's very easy to do. You can do that at any time. You just need a government gateway login that you use for things like your passport application, driving license, child benefit, all those kind of things. And you can have a look and see whether you have those full 35 years worth of national insurance contributions. And if you haven't, it will tell you how many additional years you need to work until you will have them. So it's another important part of putting all of the pieces together for planning for your retirement. So if you haven't done that, it's very quick and very easy to do. Well worth just taking 5 or 10 minutes out to have a look into that. So there's lots of useful information out there to find out more about all of these options in your pension. So Civil Service Pension Scheme website is full of lots of useful information. You can find out about the different options that are available. Use the calculators there as well to assess if any of these options are going to be suitable for you. Find out more about HMRC's annual allowance if you think that is something that you need to factor in to your retirement planning. So do consider that and find out a little bit more about it. Visit the state pension website for a state pension estimate and find out any other pensions that you may have. You might also want to consider just finding out more generally about your civil service pension. So again, we've got pension power sessions that are available every single day. You can sign up to attend one of those 1-hour sessions and find out more about your pension. You also might want to consider listening to the Civil Service Pensions podcast, which launched fairly recently. So there's 6 episodes all about your pension on topics, things like retirement, what's so good about the civil service pension, why should you think about thinking about your pension in your 30s, all those kind of things that you can consider. So all of that can feed in to help with your retirement planning and help you decide whether you actually need to boost your civil service pension. And it's something that you should consider doing now. So that's the end of my presentation, but I'm just going to now do the demo of the added pension calculator. So let me just get that up onto my screen for you. So here we have the added pension calculator. So you'll find this on the tools and calculators page of the Civil Service Pension Scheme website. You'll see tools and calculators on the blue bar at the very top, or you can use the search box and type in added pension calculator. It's very easy to find. So like I mentioned earlier, the only option that you have when buying added pension is to buy added pension in the Alpha scheme. So this is the Alpha Added Pension Calculator. So it asks you to populate some of your information, and I prepared this earlier, so be nice and ready for this. So popped in a date of birth, put in a gender. It asks the question, do you have at least 12 months of pensionable service in the Alpha scheme? To which I have said yes. And everyone should tick yes on that box, because even if you only joined Alpha on the 1st of April 2022 as part of the 2015 remedy, you still have the option available to you to buy added pension in Alpha. It then asks, when would you like your added pension contract to start? So I'm going to put in the 1st of April 2023, assuming that I'm going to start buying this added pension by monthly contribution from my salary. It asks the question, what sort of pension do you want to buy? And in the drop down, it gives you the option of self or self and dependents. So with Alpha, when you're buying added pension, you can choose to just boost your personal pension, or you can also boost the pension that's payable to your dependents in the event of your death. So obviously your personal circumstances will influence which of those choices you go for. There is a difference in cost, but it is quite minimal. So I'm going to go for self and dependents. It then asks you, do you want to calculate a pension amount or a payment? So with this option, what it's saying is, do you want to calculate a payment? So for example, I can afford to pay an extra £100 every month. What does that give me back as additional pension benefits? Or if you're calculating a pension amount, you're saying, I'd like an extra £3,000 worth of pension paid to me every year in retirement. How much will I have to pay to get that much back? So let's do it as payment. And I will say I can afford to pay an extra £100 every month. Oops. Just put that in the wrong box. User error there. Sorry about that. There we go. So I've said I'm going to pay monthly and I'm going to pay an extra £100 a month. And what that then does is if you scroll down, you will see the results. So what that tells me is I have chosen to calculate a monthly payment of £100 per month. This will purchase a self and dependents added pension of £97.58. So what the Alpha Added Pension Calculator does is it assumes you're going to pay that £100 per month extra contribution towards your pension every month for one single year. So it doesn't project for the future. It assumes you're just paying that contribution for one single year. So if I was paying in £100 a month, in 12 months, that would be £1,200 that had been contributed towards my pension. And that means that £1,200 contribution is buying an extra £97.58 of Alpha pension that will be payable to me every year in retirement. Now, at first glance, you might think, that doesn't sound like I'm getting very much for my money, but there's lots of things that we need to consider. So the first thing I'll always do when looking at this is saying, well, how many years will I have to live in retirement to make sure that I'm going to get my money back? Because that's the key thing, isn't it? You want to make sure you're going to get value for money. So if I just take the contribution, which is £1,200, and divide it by the £97.58 it's going to buy me, then that tells me I'd have to live 12.29 years in retirement to make sure that I'm going to break even and get my money back. But we have to consider all of the other factors as well. So key thing being the tax relief we've talked about. So whilst I've said I'm going to pay £100 every month, it's not actually going to cost me that much because I'm going to pay less tax. And how much less tax you'll pay obviously will depend on your earnings and your personal circumstances and your tax code. But also the added pension that you buy is going to be adjusted every year in line with inflation, both whilst you're in service and also while those pension benefits are payable in retirement. So taking into account the tax relief and the inflation, while initially it looks like 12.2 years I'm going to have to live to get my money back in retirement, actually factoring those in, that's going to bring those number of years down. That might end up only being 7 or 8 years I actually have to live in retirement to make sure I'm going to get my money back. And obviously you just need to make sure that you're happy with that in terms of the level of risk. Obviously no one knows what the future holds. Will I still be here when retirement comes? No one can possibly answer that question. But those need to be things that you're comfortable with when planning for the future and thinking about these different options. So that's how the added pension calculator works. There are lots of useful notes towards the bottom. So do take some time out to read the notes that are available, which explain a little bit about how this calculator works. And also, I'll just show it there, we've got some ability for you to leave some feedback. So for example, you've used the added pension calculator before, you weren't quite sure how that all worked. Or if you use it now and you think it could be improved, then please let us know. We're really interested to hear your member feedback to see what changes we can make to make things more useful and easier for you in the future. So hopefully that's been helpful. That ends my demo now, and I'm going to hand back over to John. So thank you everybody for listening to me for such a long time. Back to you, John.
Thank you, Catherine. Thanks, Catherine. That was really, really helpful. Thank you very much. Catherine, you mentioned the added pension deadlines there. Would you just like to remind everyone what those added pension deadlines are?
Yep, so no problem. The added pension deadlines are published every year. We haven't got them for 2023 as of yet, but generally speaking, it's normally around the first week of March is the deadline for buying both added pension and EPA by monthly contribution from your salary. The contribution for buying added pension by lump sum to count for the current tax year will be a little earlier. It'll be in February, but they'll be available on the Civil Service Pension Scheme website in the new year, but your employer will also publish them online for you. So watch out for them when New Year comes. Maybe have on your New Year's resolutions. I'm going to think about boosting my pension early in the year, and that's a really good time when you can think about it.
That's brilliant. Thanks, Catherine. Okay, so we're going to go to the results of the previous polling question now, and we asked you how do you currently manage your pension? Well, the results are in. I can see that 36% of you have said that you use the pension portal, 30% of you use the pension portal plus modelers, 26% just by looking at your ABS, and 8% other. So thank you to everyone who voted and provided a response to that. If you are one of the 34% who aren't currently using the pension portal to manage your pension, I would really recommend that you start doing so. Once registered and logged into your account, you can view your latest ABS. You can use the pre-populated modeler to forecast your retirement benefits. You can update your personal information, and you can change or make a death benefit nomination. So it really is worth registering for the portal. To do that, simply go to the scheme website and search Guide to Registering. You can do that in the search bar, which is located in the top right hand corner of the website, and on that page there's a step-by-step guide and a video. Okay, so you will have noticed that another poll has now appeared on your screen, hopefully, and the question we'd now like you to answer is, what is your main motivation for boosting your pension? So that's going to be on screen for the next few minutes or so, so please do let us know your answer to that one. Okay, so moving on, I'm now going to hand over to our next presenter, Tim Ferber from Client Director at Legal & General, who'll be telling us more about how Legal & General are supporting members who are contributing to a defined contribution scheme. So over to you, Tim.
Great, thanks very much, John, and welcome, ladies and gentlemen. I'm delighted to be here as part of the Pensions Awareness Week on this session about how to boost your pension. So today what we wanted to do was go through in terms of some of the tools and tips that we've got to try and help people keep in contact with their pension scheme going forward. And what we're also going to do is try and bring to life in terms of that support by using the pension scheme microsite that we've built for the Civil Service Pension Scheme. So we've already heard from Catherine in terms of how defined contribution pensions work. And one of the big differences between the defined contribution section and the civil service pension is that with defined contribution pension, there's no guarantees in terms of what your final income will be from the pension fund. It depends in terms of how long you've been saving for, how much you pay in, how your investments perform, what the rate of income exchange is when you get to retirement age. And so what we have designed is ways and means that we can keep people in contact with their pension pot so that they can see in terms of what their future value is going to be and hopefully what their future income will be as well. And what we're going to be using today is the retirement savings checklist, which you'll find on the pension scheme microsite. It's in the document library. So first of all, let me just bring up what the pension microsite looks like. It's here, it's legalandgeneral.com/CSP. And what you'll see there is we've got the three different elements of the overall defined contribution section. We have the civil service AVCs, Concord, and partnership pension account. And so for the purpose of today, what we're going to do is we're going to bring the pension microsite to life. And by the magic of Zoom, I brought it hopefully through onto your screen. Hopefully you can see that now. And what we're going to be looking to do is talk you through in terms of the pension microsite itself. So if I clicked on the partnership pension account, that will then bring up the section here where we can see all the details about the partnership scheme itself. We've got lots of information based on the where you are in the savings journey. So if you're very young, just joined the pension scheme for the first time, then we've got limited information here about how pensions work, contributions, and how your pension is invested. At the other end of the spectrum, if you're quite close to retirement, then we focus on what you need to know as you prepare for that transition from work into retirement age. And we've got lots of tools to try and help members. And one of the tools I just want to share with you now is in the arriving section, and it's at how long will our savings need to last for. And the reason why we put this tool onto the site is because people often tend to underestimate how long they're going to live for and overestimate how long they've got to go until retirement age. So the ONS calculator allows you to see in terms of what your average life expectancy is. So I don't mind sharing with you today that I'm a 51-year-old male, and the good news for myself is that my average life expectancy is 84 years. And Catherine mentioned already this just earlier now in terms of that crossover between how long you'd have to live for to recoup the additional money you've paid in for your added pension years. So for myself, I'm expected to live for a further 84, up until 84 years of age. So I'm 51 now. My state pension age is at 67, so that's another 16 years. And I'm expected to live to 84, but there's a good chance that I'll live into my 90s and potentially even get a telegram from the King, a 4% chance I'll live into my hundreds. So it's great that we are living longer, but it does then mean that we have to plan for our retirement for a longer period of time. And the other thing I mentioned is that people tend to underestimate how long they've got to go, overestimate how long they've got to go to retirement age. If I'm 51 now and I'm retiring at state pension age at 67, that's just 16 more years to go to retirement. And that is 192 more paydays before my last paycheck. So time is of the essence. And that's why really the focus in terms of defined contribution schemes is keeping in contact with your pension pot and making sure you're on target to meet your goals. And if you're not on target, you want to make changes as far away from retirement age as possible when you've got more opportunities to get back on track in the future. So the first element in terms of the retirement checklist is how you can keep in contact with your pension account. And a simple way to do that is through Manage Your Account or My Account. And to do that, what you need is your customer reference number, which we'll find on your membership certificate when you first join either Partnership, Concord, or the AVC. You need to put that in along with your name, date of birth and postcode, and then the system will go off and it will find you on our database. And then once it's found you, it will send you back a link. You can just complete the security questions and you're into your own account straight away. And you can access your pension 24 hours a day, 7 days a week, the pension information. So you can see in terms of contributions coming across, the current fund value, where your money's invested. You can make changes to where your money's invested as well. If you move house in the future, you can update your personal details so you don't lose track of your pension scheme. We've also put lots of other useful tools in there as well. So the retirement planner, which brings into your calculation your personal details from your pension policy. You can also register for My Future Now, which we'll come on to later. And one key thing, which Catherine mentioned in her presentation just then, is we have the expression of wish form. And that allows you to tell the trustees who you'd like the value of your pension fund to be paid out to should you die before you retire. So it's a really useful tool. We know lots of people use it already. About 2/3 of the AVC members have registered, about 60% of partnership members have registered, and we always take the opportunity to try and promote Manage Your Account whenever we can, because we'd like to drive those numbers back up. Now, if you want to access your policy details through an app, we also have that. If you go to Google Play or App Store and put in Collate, COLL8, and you can download the app. And again, that gives you access to your account through Manage Your Account. But it's also got other pension related information as well. So the next section in terms of the retirement checklist is about contributions. And as we said, in terms of the DC section, there are 3 different elements to that. The civil service AVC, if you're paying contributions in, these are contributions coming out of your pay, and they're going to this savings policy. That policy is then a long-term savings plan insofar as that you can only access your pension account until you get into your mid-50s. If you're in the Concord scheme, it's an auto-enrollment scheme, so you get an employee and an employer contribution. And the partnership scheme, which we're talking about or using today, that's a non-contributory scheme. As Catherine mentioned, you don't have to pay contributions in if you don't want to. But if you do want to pay contributions in, those contributions will be matched up to 3%. Those contributions, when they come across to Legal & General, are then invested in funds or funds that you tell us you wish to invest in. So if you want some further information about the investment options, in the first step section, how your pension is invested, we've got lots of information there to help you understand in terms of the default fund. So for partnership, it's target date funds. For the CSABC, it's multi-asset fund as well. The trustees also offer a wide range of funds to choose from. So that covers all the asset classes such as cash, bonds, gilts, property, and stocks and shares or equity. So you've got the ability, if you wanted to change where your money is invested. You can invest in as many of the different funds as you wish to, and you can change it as often as you want. And the simple way to do that is through Manage Your Account. So if you want to take less risk, you can. If you want to take more risk, you can. If you have an ethical or a focus in terms of environment, social governance, we have funds that can offer that as well. And for those people that are very keen in terms of finding out more about their information on their pension funds, then we've also got access to the Fund Centre, where you can find out information about past performance. Now, whenever we talk about performance, we also have to make the note that past performance is not a guide to future performance. And also it lists in terms of the top 10 holdings in that pension fund. But if you want further information about where your pension is invested, then in the app, we've linked through to an organisation called Tomello, and that will break down all of the underlying companies in your pension investment. And what's brilliant about Tomello is it gives you a voice on upcoming AGM resolutions. You can express whether you're in favour or against, and that information is being shared with our active ownership investment stewardship team and also with the trustees as well. So your opinions are now being shared with the trustees. The next section on the checklist is about bringing across past pensions. Again, Catherine mentioned this in her section. And we have had the pension tracing service available for a while. We are due to get the pensions dashboard coming in due course, hopefully starting next year. But in the meantime, we've also been able to launch a really unique and useful service called My Future Now. It's a company that we've invested in, and it's now part of the Legal & General group. And it's a service that we can provide to AVC, Concord and partnership members free of charge. And what happens when you register is you provide details about your past employment history or your past pension history. And just as Catherine mentioned with the pension tracing service, what happens is My Future Now go away and they find your past pensions. Every time they find one, they send you an email. You go back into your personal dashboard and you can see the information about that past pension. So it tells you about what you've built up, the values, the charges, any guarantees you might lose on transfer. Now, not every pension requires transfer advice. The trustees will allow for a lot of defined contribution schemes for individuals to transfer using their own information and opinions. There are some pensions, however, that do require financial advice, and these are pensions that have guarantees. And so the trustees will require you to get financial advice for those pensions. But for a large proportion of defined contribution schemes in the UK, you can transfer once you've got the information to hand, and you simply click a button and that request goes through to Legal & General. The final element of the retirement saving checklist is trying to identify what target income that you want in retirement age. And for a long while, this has been quite difficult item for people to understand. There's been certain rules of thumb as to how much you should save how much you should contribute when you first start saving. But recently, the Pensions and Lifetime Savings Association, along with Loughborough University, came up with their own retirement living standards, and we're delighted to support this. We've put the retirement living standards tool within our useful tools section on the pension scheme microsite. And what this now allows people to do is to go off and get a sense in terms of how much they will need to fund to maintain a standard of living in retirement age. So whether you're a single or a couple, whether you're living outside or inside London, or whether you want to see your income before or after tax, you can get a sense in terms of how much your retirement is going to be costing you. So let's say my wife and I, we want a moderate level of income in retirement age. So I would need to try and fund £31,500. Now I can, for example, come back into the retirement living standards modeler, and I can adjust the different elements that make up this overall lifestyle in retirement. So for example, I might decide that I don't want to spend quite as much per week on the household, but equally, as I'm young and active, just going into retirement, I might want to spend more in terms of holidays and leisure. So I can adjust in terms of what my lifestyle is going to cost me in retirement age, and I now have a target to which to try and reach. So just like the added pension calculator that Catherine just demonstrated there, we also have a retirement planner. And the aim of this tool is trying to help you identify if you're on track to get your retirement income in retirement age. So every year you'll get your annual benefit statements, which gives you an indication about how your fund is performing and what you're on track to get as an income. But you also have access to this planner so you can keep in contact on a more regular basis as well. If you access the retirement planner within Manage Your Account, because it's in a secure website, all of these details will be pre-populated with your own policy information. But because we're outside of Manage Your Account, we have to populate this ourselves. So as I said, I'm a 51-year-old male. I am going to be retiring, and I want to retire at, let's say, 65. And I've got built up a fund of £50,000, for example. And then here we have our retirement living standards. So whether it's a minimum, moderate, comfortable level of lifestyle, or I can put in my own value. So for an AVC member, for example, you might already discount the income you're going to get from your civil service pension. Equally, you might decide you want a different level of income to achieve. So I'm going to go with the moderate living standard. Because I'm outside of the retirement planner, then it assumes I'm in a default fund, not the default fund for partnership, but the default fund for AVC, which is our standard default fund. And because this is the partnership scheme, what we'll see here is that if I put in information about my contributions, then I can put in an amount of money being paid in, let's say a percentage of my salary, and I put in my salary down here. And then what happens is the modeler will go off, and it will go off and it will work. To Daisy, right. So I'm going to say I'm going to retire at 65, although the normal minimum age is 67 in the pension scheme. I put down there a moderate living standard going forward. Because this is a model that we've set up specifically for partnership scheme, you can see that my age-related contribution is there already. And I've got the ability, if I wanted to add contributions in. And if I do that, my contribution increases down here. And so what the modeler does, it goes off and it shows us in terms of how much money I could build up based on the information I put in there. And it shows me also in terms of what target level I've got going forward. So if I want to see in terms of how much money my income will last for in terms of flexible income, I can do that. I can adjust in terms of the contributions I pay in. So for example, I might decide to pay in 3% to see how much money that builds up. I might have other pension funds that I've tracked down through My Future Now, so I can include those into the modeler as well. So what the planner aims to do is show us in terms of what we're on track to get in the future, and how we can get back on track in the future going forward by either adjusting contributions, investments, or how long we're saving for as well. So I hope that's been of help, just to give you a quick navigation around the pension scheme microsite. And on that basis, I would like to say thank you for your time today and happy to take any questions.
Brilliant. Thank you very much, Tim. Okay, so we are running out of time. So what we're going to do very, very quickly is just go to the last polling question, which was, we're just going to have a quick look at the results, which was, what is your main motivation for boosting your pension? And I can see that 82% of you said that you're not 100% confident that your pension will support your lifestyle when you retire. Well, hopefully some of the things that we've covered today will give you the confidence to maybe start planning your retirement and looking at a bit more in a bit more detail of that to see what you could do. And obviously, if you do have any questions, please go to the scheme website. As everybody has said today, is a mine of information. Okay, so we have a few minutes left now. So what we're going to do is try and cover some of the frequently asked questions regarding the topics that you voted for. And I can see that the top two topics are different boosting options and added pension contributions. So we'll quickly go to the first question in different boosting options. And this is for you, Andy. And it is, how can I find out which boosting option is right for me?
Great question, John. Thank you very much. What I would say, but what's the best, it depends on your own individual circumstances. Individuals like added pension because it's safe, there's no risk. However, a lot of people like to use CSAVCs if they want a bit more of a say in how they want their pension to be funded. So where do they want things invested? So like Tim mentioned, ethical funds or green initiatives, things like that. What are they individuals passionate about? What I would say, as always, is check on the website, have a read over and think what is best for you. Use the tools that Catherine showcased with the added pension calculator and Tim showed with the retirement planner on the Legal & General website as well, just to see what you feel is going to be best for you to provide the income that you want in retirement. Back to you, John.
That's brilliant. Thank you very much, Andy. It's really helpful. Catherine, this question is for you, and it is, which is better, buying added pension or AVCs?
Thanks, John. It's really difficult to answer that question. So I think the main difference to think about between the two is added pension. You know exactly what you're going to get back, pretty much, other than the inflation, which is unknown. So it's safe. You know what you're going to get for the money that you pay in. AVCs is more unknown because it's all based on investments. You don't know how they're going to perform. So I suppose you need to think about how much of a gambler you might be in terms of whether you like that risk or whether you just want that certainty of what you're going to get back. Those are the real factors to consider which one's going to be the best one for you. So there's definitely not a best option. They're both really good options. It's just deciding whether you're comfortable with that risk or not. I think that is the key factor between them. Back to you, John.
Brilliant. Thank you, Catherine. Emily, we haven't heard from you today, so I'm going to bring you in for this one. What does the added pension calculator tell me?
Hi, thanks, John. Hi, everyone. Yeah, first time jumping in today, so I'm glad that I've been able to jump on. The added pension calculator, it can tell you one of two things, really, and it depends on how you approach the calculator. So you can calculate either paying in a certain amount, i.e. I have X amount of spare cash, how much extra pension would that buy me? And the amount quoted is going to be an annual pension amount. Or you can say, you can approach it in the way of, I would like to calculate a pension amount. So I've got an amount of pension in mind. I would like £1,000 additional pension, for example, at retirement. How much would that cost me to buy? So they're the two ways that you can approach it. And either way, the results will show at the bottom. The results at the bottom, what it tells you, like I say, whenever it's talking about a pension amount, it's talking about an annual rate of pension, and that's pre-tax as well, so gross. So always just keep that in mind. That divided by 12 would be a monthly income. So back to you, John.
Thank you very much, Emily. Okay, this is a fairly broad question. How do I know whether to boost my pension or not? Catherine, you've probably covered this in your presentation, but could you just recap, how do I know whether to boost my pension or not?
Thanks, John. It's all about figuring out whether the pension benefits you've got already are going to be sufficient to live the kind of lifestyle you plan to in retirement. So like Tim demonstrated, there's some really useful tools out there to think about what that figure might look like. But obviously only you know your personal circumstances in terms of what outgoings you'll have in retirement versus what you're going to have coming in. And if you think, well, yeah, I would like to have a larger pension in retirement. When work is over, I want to be able to enjoy my time. And that's when you need to be thinking about, okay, I can afford to boost my pension. And don't forget as well, the earlier you start to pay that little bit extra, the less of a burden it's going to feel in terms of the level of contribution that you pay. So it's always best to be engaged with your pension as early as possible. And if you do want to pay something extra, then you can do it on a much gradual basis over a much longer period of time. Thanks, John.
Thank you very much, Catherine. And unfortunately, we have now run out of time, so that will be our last question for today. Well, thank you, everybody, for joining us. Thank you to our panel. We covered a lot there. Finally, for me, I would just like to say that if you haven't already attended a Pension Power session, then I would strongly recommend that you do so. You can find more information about Pension Power by clicking the blue button that should be on the bottom underneath the screen. On the I think it's on the right hand side, I'm going to say, and it's just finally one final thing for me. If you do get a chance to download the Civil Service Pensions podcast, please do. It is a cracking listen. Just simply go over to any major podcast platform and search Civil Service Pensions podcast. That's it. Thank you very much for joining us today, and enjoy the rest of your day. Bye bye.